All right, so I'm redoing a video I did some time ago on how to read a DOM. So this video is going to be basically how to read the DOM. It's also called a depth of market or the ladder, which is kind of slang. Um, this is going to be it's going to allow you to really comprehend how to read it at the end of this video. So we're going to really dissect things, what everything means, and you should be confident because there really are a lot of components. However, once you understand how the DOM works, it really does open up a lot of opportunities no matter what market you trade or your trading style. Okay, so I do trade futures and I scalp futures. Now, just because I do that and I show you how to do my trades where I would get in and out doesn't necessarily mean it won't work for you. The DOM actually works pretty well with indicators. In fact, the DOM is great for super fine-tuning your entries, whether you're swing trading or just going long for months on end. The DOM is the ultimate tool for precision entries. That's why I love it. And in fact, you really don't need charts to trade it if you're a day trader and you scalp. And that's another beauty about it. And something else that I think is a great perk with the DOM is you can have multiple DOMs next to each other. Therefore, you can watch several markets, and it's a lot easier to really understand what's going on while watching a DOM versus a chart. A chart has so much history with the candlesticks or whatever chart you use, line charts. All it is history. The DOM is basically just showing you what's happening right now, and that is pretty much it. Now we're going to just jump into it here, and I'm going to break down what all these columns mean. So the first column and the most important column is this gray column. Okay, and again, this is a Saturday evening for me, and this is a live DOM. This is the E-mini ES futures contract, the E-mini S&P 500, and this is currently where the price is trading. Of course, it's a futures contract, so nothing is happening on a Saturday night, so it is dead, and it is not moving. So you're going to see these numbers in the white font. These are my prices. You got 21.00, 21.25, 21.50, 21.75, then it goes to 22. You see this white box? It's highlighting 21.25. That is currently the price that this market is sitting at. Okay? So if you saw this going up and down between 21.25 and 21.50, and you're watching, say, a chart with a 1 minute chart, you would see the candlestick going from, say, a doji to a green candle, doji, green candle. Just when you're seeing a candle form, what you're seeing is this price ticking between these numbers. So if this white box, if the price moved from 21.25 to 21.50, this box would be highlighted white, and that would be a tick up in the market. If it went down to 21 even or 21.00, that would be a tick down. Now, this is not $21.25, just so you're not confused. I can expand these columns, and the particular DOM I'm using is from a company called Jigsaw Trading. I'm not completely sure. Anyways, you can customize the colors and the information. You can delete columns. They have really world-class DOMs, and that's why I like them. But just to make reading it easier, I do cut off this part where you see 29 all the way up and down. It's just kind of pointless. So I'll do this so that way it's easier to read, and it brings my information in tighter. The tighter you can get these columns, the better. Anyways, because you want to be watching everything at once, but that takes some training. Anyways, this is the price. Okay. The next important column is this one over here with the seafoam green histogram. It almost looks like a volume histogram on a traditional chart, and that's actually exactly what that is. That is a volume histogram. What's great about it, though, is these numbers here are measuring how many it's telling you how many contracts traded at that price. So at 19.00 or 19 even, 95,435 contracts have traded there. Okay. Now, that's how many contracts have traded in a 24-hour period. DOMs are going to be set up differently. It really depends how you do it, how you want it. Since future markets just generally trade between a certain set hours, my particular DOM resets every 24 hours, roughly around 4 p.m. Central Time, Chicago Central. Okay? So every 24 hours, around 4 p.m., all these numbers you're seeing will disappear. And they're going to have to be rebuilt the next trading day. Okay? So for instance, during this particular trading day, this particular 24-hour session, the price has traded all the way up to, and I'm going to expand this, 2925.50, and the lowest it got for this 24 hours is 2912 even. So, and then, it just keeps going down, 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 down. Then it goes to 28, where these numbers go from 29 to 28. Anyways, that is a 24-hour trading period, and that's how many contracts traded at each price during a 24-hour period. So, as you can see, it kind of trades a lot more right here, and this is the biggest volume profile at 29.19 even. And what's great about that is if you get comfortable with reading the DOM, you'll see sort of what's significant about that. And I call this a peak. At 19, there's so many contracts that have traded here, it looks like the peak of a mountaintop. Well, when the price trades down to that point at 19 even, it's going to get stuck there. This is going to be somewhat support or resistance. If you're coming up, if you break through this 19, you trade down to, say, 1650, you reverse and come back up, the price will get stuck here at 19 even. So a play can be had around that. You just have to sort of figure it out for yourself. At least I try to play around there because I know that's support and resistance, and I know there's opportunity when price is trading there. And it acts like a magnet. If the price leaves 19 and it leaves with very slow velocity to, say, 20 even, it'll want to pull itself back to 19 even. So I know a trade is to be played in there. Also, trades that are to be played is the profile edges. Now, this is called a profile. See, it makes a profile. It almost looks like a mountain. And then you have this little valley and then another little rolling hill right here. And then another valley, another rolling hill, another valley, another rolling hill, and then it tapers off to nothing, like you're almost going into the ocean, like the land mass is disappearing. And then inside here, there's a massive mountain. That's kind of how that sort of helps me understand what I'm looking at better, to use terms like that. So 25.50, this is a good place to play. This is a good place to scalp the market because this is going to be where an edge is. There's going to be resistance here. There is. So for every 24-hour period, if the market doesn't trade past here, I know for sure that's resistance or support, and this would be support at 11.75. So one thing we're going to do is I'm going to go over a trade that happens at one of these edges, and it's going to be a breakout trade in this particular market. But before I go that, we need to finish going over what these other columns are. So anyways, over here, this is where I can write notes. So I can write, and not every DOM has this. I'm going to write high. Okay, so that's the high. I can go down here and I can write low. So, it just helps me realize if I notice the price is bouncing right here, I can put a B for a bounce. Maybe it's bouncing between here and say 2025. So I'll put here, and I notice that it bounces off here twice, so I can put 2. Okay, maybe the price bounced off 2025 2 times and it keeps going down. So that helps you keep track of what's going on. I like it. And it's kind of like using technical indicators on a chart. And in fact, you kind of see a chart happening in your head when you watch these profiles happen, because the market just moves up and down. That's all it does. And instead of looking at historical data, you're looking at what's happening now, and that's all that's important. Really, what happens in the history doesn't matter. And you could argue with me, and I agree and disagree with what I'm saying, but that doesn't matter. We're here just to learn how to read the DOM, and I just went off on a tangent. Anyways, this black line right here, this is just the center line, so I'll recenter. That allows me to line up multiple DOMs, so that way if there's correlating markets, I can line them up evenly and just watch several markets trading with each other or against each other, and that kind of helps me figure out when to enter the market. So, that's another useful thing with DOMs. It really helps with watching correlated markets in the now at the same time. Anyways, you should understand. I'll recap real quick. These are the prices. The gray boxes over here is the volume histogram of total contracts traded at whatever price. So, currently we're trading at 21.25. Only 15,797 contracts have traded here. If another contract came in, it would go to 15,798. If another contract came in, it would go to 15,797. Or 90 whatever. So this keeps going up one by one by one. The minimum contracts you can trade in the future market is 1. So this is the minimum amount, and it's just a way to measure stuff. Anyways, let's move on. Before I go off on another tangent, this blue column here is the buyers or the bids. The red column is offers or sellers. So if you plan on going short, you're going to be you're going to want to be entering in on the red column. And if you're wanting to go long, you're going to enter in on the blue column. And what you can do is you can click on the DOM on whatever price you want to get in, and that's how you can execute a trade. So instead of like executing a trade off of a chart, you can just execute your trade straight off the DOM. So if you do use charts, I do recommend having a DOM next to it, so that way you can just sort of manage your trade a little easier. And when I show you that breakout trade, it'll make more sense. So most of you should know what limit orders and market orders are. Limit order gets you into a certain price. Whatever price you want, you put in your limit order. Market order gets you in at the current price. Remember that. These columns in the center, don't worry about those right now. However, again, team blue or team red. So if you're going long, blue. If you're going short, red. Before I explain anything further, we're going to go to the next screen. So let me pull that up. This may be confusing. Because it's a lot of fucking numbers. I get it, and this could be a huge turnoff for people that want to trade the DOM. But you need to understand that this is actually pretty easy to understand, and it doesn't take that long to get good at reading all these at once. This is several markets I have on my screen. And this is a recorded session. The video is paused right now. However, you're going to ignore most of these markets, okay? And in case you want to know, I'll just sort of go over them. This is one market over here where the blue and red column are. This is one DOM. You can sort of see the edges, and you can see how I have the black lines all lining the markets up together. So if the markets get out of whack, for instance, this should help you. Let me pull something up for you. Here we go. Okay, so here's my what I usually watch. Okay, so this is 1, 2, 3, 4, 5, 6 markets. Okay. So for instance, let's get the markets all whacked out. So pretend these prices have all traded to different areas. Okay. See how nothing's aligned right now? If I just right click up here, it'll realign everything with the black bar. So that's what that is. Now give me just a second. Since it's a dead market, I need to re-pull up that video, and I am live streaming this. It's just sort of easier to do videos like that. So we're going to be looking at this particular market right here. Okay, this is the ES. This one over here is the 10-year Treasury note. This one over here is a 30-year bonds. This one over here is a 5-year notes. This one over here is the 10-year, and part of it is cut off because I overlaid the ES. So we're going to be watching the ES, which is this particular one right here. Okay. So, and you're going to be seeing a mouse moving on there. You're going to see 2 mouses. One of the mouses you're seeing is from the live session, okay? So you just need to kind of keep that in mind before I break this down. All right, or before we play it. Now, let's further analyze what's going on here, okay? As you can see, the blue and red columns have numbers now. That's what happens when you're trading on the DOM during a live session. There's actual action. So let's focus on the blue and red columns, not these gray columns with the red and blue numbers. Don't worry about these gray columns. Ignore those. Let's focus on the blue column here. Okay? So you see 336. That is 336 contracts. And that is a limit order. There's 336 on the bid at $29.1675. So it is currently at this price, $29.1675. A total of 3,424 contracts have traded at this price. The price above it, only 152 contracts have traded at this $29.17 even. So we are currently at an edge, okay? So we're at the edge of the profile, and as you can see, the profile down here near 29.13 kind of goes up and then down into this valley, and then at 29.16 even, there's a peak right here. So this is a peak in the profile step with 8,011 contracts, which have traded there in total. And if you go over to the right, there's 385 contracts on the bid at this 29.16. What you're seeing in the blue column is live orders. These are limit orders, and these are limit orders sitting at whatever price people want to get into. So if we go to where the market is currently trading at 29.1675, there's 336 contracts on the bid. There's 336 people, or there's one guy with 336 orders. It could be any of that combination. So it's either 3, and then the chances of it being 336 traders is slim. It's going to be a lot less. You know, one guy could have 5 contracts in there, another guy could have 10 contracts, another guy could have 200 contracts, another guy could have 50 contracts. So it could be several traders, or it could be a few big traders. And you can kind of figure it out. That's something that's a little more advanced, and I'd have to explain in another video, but let's just keep it simple. Those 336 contracts have to be bought before the price can tick down to 29.1650 even. Okay? So in this red box, this is the market order. Okay? I want you to ignore the other side of this. This red box correlates with this 336 in the blue box in the column. And this is where the market is trading, because this is where red clashes with blue, okay, at this line right here. Between 29.1675 and 29.17 even, this is where the market is currently trading, okay? And this is where blue meets red. So right here you see the number 6 in the red box, okay? 6 contracts have market ordered in, okay? And again, a market order is buying the market now. You can either limit in or you can market in. And if I was to limit in at this price, I would be in a queue of 336, okay? So if I was to buy one contract and I wanted to get in at this price, I would click on this blue box and you would see it go to 337. If I decided I didn't want to be in the trade anymore, I could cancel my order and it would go down to 336. If I was to buy 2 contracts and I got in at that price, it would go to 338, okay? If I was to buy 4 contracts, it would go to 340. So you would see this number go to 340 with my 4 contracts, because 4 plus 6 equals 10. It goes to 340. If I canceled all 4 contracts, it would go back to 336. Now, if I do get in there, I'll be at the back of the line. So 336 contracts have to be sold before I can get in. Okay, and that's why simulation trading kind of sucks. If you limit order in on a simulator and the price taps your order, you automatically get filled. That means your trade has been executed. You're in the market. That's not how it really works. Simulation is a complete lie. So just a warning if you're still doing that. So what happens is I get in a queue, I'm in a line. Think of it as a line. It's first come, first serve. 336 contracts need to be filled before my order. Now, if I'm in the line and 100 contracts cancel, I'll move up in the queue to 236. So I'm in 236. Now, if those 100 contracts come back in, it would be 340. However, I would be further in the line, if that makes sense. So if you cancel your contracts, that's you getting out of line. Pretend you're at a line for, say, I don't know, McDonald's. If somebody leaves a line, you move up. If they decide to get back in the line, they have to go to the back. Does that make sense? I'm going to go over that again. You're in a line. If the guy in front of you leaves, if 2 people in front of you leave the line, you'll move up 2 positions. If those 2 people decide to get back in the line, they have to go to the back. They cannot cut in front of you. Okay? And when you execute a trade on this particular DOM, it'll show you roughly in the queue where you're at. So pretend I was one of the first people to get in at this price. It could show me, say, in position 100 out of 336. So if 100 contracts get bought up, that means I'm in the trade. Okay? Now, the thing is, the market could trade here, and then it could bounce back up, and my order may not get filled. So just because the market trades at that price and I want to get in that price doesn't mean I will get in at that price. So this 6 right here means 6 contracts have bought at this price. So if another 6 contracts come in, this would go to 12, and this 336 would go to 330. Again, if another 6 contracts come in, 6 of these will disappear, and this 330, it will go to 330. This number will go to 12, okay? Just because there's limit orders doesn't move the market. Market orders move the market. So these orders in the center are market orders. Same thing with up here. There's 627 contracts on the ask. There's 627 sellers at 29.17 even. Here's the price over here. Okay. And just a little quick tip. This other thing with the yellow right here, this is the exact same DOM as this one. This is the ES. However, you can see the prices match up perfectly between these two columns. The only difference is highlighted yellow. There's a reason for it. I'm just not going to get into it. I want to go over this. This is a long enough video. Anyways, you have 627 contracts. So far, 15 buyers have marketed ordered into this position at 29.17 even, and 15 contracts have been executed. So therefore, let's pull up a calculator that kind of help you get an idea. I'm not good with math in my head. So 627, so we'll do 627 plus 15. Okay, so this was originally 642 contracts. Well, 15 contracts have market ordered in at this price, so therefore it dropped down 15 contracts to 627. Okay, so you need to really pay attention to everything to comprehend what's going on with the DOM. And more so, you want to pay attention what's going on these middle columns between blue and red. You want to really pay attention there, especially when it comes down to the second you click your mouse to make the entry or the exit on the trade. This is where you want to really be paying attention. So again, you have limit orders, which go in the blue column and the red column, and then you have market orders that go in on the inside columns. Now, sellers have to sell to the people on the bid at this, so 336. And what helps me identify the sellers is their numbers are red. So where you see the 6 and the 336, they kind of go with each other, and then it's staggered right here. The market's going to be staggered like that. That's just how it is. That's where the market is trading. This is where the bid and the asks are. You know, this is what moves the price up and down. So just because it's, and it being staggered helps you identify what's going on, and that's just how it is. So, my red numbers are sellers actively buying up the bids, or my buyers actively buying up the offers. So that's what's going on. Again, sellers actively hitting the bid, or buyers hitting the ask. So I'm going to use terminology like that. So try to follow me, and I'll try not to get too crazy with the terminology. So I'll say the seller's hitting the bid. That means their market orders are actively going up right here. This number will go from 6 to 12, or, maybe it'll go to 300, and then 300 of this gets bought up. This number will drop down to 36. However, the numbers are always moving because people are always adding contracts or canceling. So the numbers are always moving up and down on the bid or the ask. So if you're looking in the blue column and the red column, these numbers will either go up or down. It's just people adding to the limit or they're canceling, okay, because they're not filled yet and they decide they don't want to do the trade. Now, these market order numbers can only go up, and that's it. You won't see them go down. And not all DOMs have market orders. They usually just show your red and blue column. They just show the limit the limit orders, which I think really handicaps you. And if you want to take full advantage of the DOM and to really comprehend it quicker and to make faster decisions, I think you need to be able to see the market orders coming in. And I think seeing the market orders coming in really gives you an edge as far as it comes to making a really good entry or exit. So, 211 contracts have traded right here. 211 market orders have hit the bid, or 211 market orders have sold into the bid. Or right here, 877 buy orders have hit the offer. 877 buy orders hit the ask. I'll say things like that. 877 buyers hit the ask at 29.1675, or I would just say 1675 for short. So hopefully you're kind of understanding what's going on. Okay. So to further dive into this rabbit hole, again, what you're seeing in the blue column is active orders. At 29.14.50, no, let's take it up to here, okay? At 29.14.75, 10,624 contracts have sold here, okay? This volume profile won't go up until the market gets there. If you see another 6 come in here on our previous example, this would go up to 12. Well, you would see 6 contracts be added to this volume bar right here. So this 3,424 would go up to 3,430 because 4 plus 6 is 10. 10 plus 20 is 30. So it would go to 3,430. If another 6 contracts came in, then this would go to 12, and then 6 of these would be subtracted. So this would go up. You would see plus 6 here, plus 6 here, minus 6 here, okay? Same thing will happen over here. Say plus 5 here, minus 5 in the red box, and then where this 152 is, plus 5. Does that make sense? You may have to watch this a few times to really, really comprehend what I'm saying. Now, let's go back down to here. 328, you may, even though the market's not trading here, it's way up here, you may see this number go up or down at any given time. So each row in the blue column at any price can go up or down. So let's play it. So as you can see, numbers are changing in the blue column. Focus on just the blue column. That's all I want you to look at is the blue column. See how the numbers are going up and down at different price levels? Okay? And then just pause it there. So hopefully you're watching the blue column. All the way down, just contracts being added or subtracted. Now this number here, this 283, these numbers cannot be subtracted. They're always going to go up no matter what. And after so many contracts trade on my DOM, they do reset. So just you can program it however you want. So this 283, this number will never go up unless the market is here. The numbers will always move at any price in the blue column or the red column. However, the numbers only go up in the center columns if the market is trading there. Now, let's watch the center column. So you see it's 53. It went to 59.61. That's how many contracts have just been added. So now if you look over here, this went up to 98. Watch this 198 climb as contracts are being added here. See, this has gone up to 224. And now you saw how that green box went to red. Okay? You may be wondering, what the fuck is that all about? Okay, this is currently telling me where the last contract has traded. If a buyer hits this right here, this box will go green. However, sellers just hit down here. That's telling me sellers were the last people to actively hit a price. So that's telling me sellers are stepping in, they're taking action. So this 31 went to 32. This 340, 49 went up to 350. And then this 392 dropped down to 391. So this went up 1, this went down 1, this went up 1 right here. Watch it, watch it. Sellers are hitting it. Oh, now buyers just hit. This went to 89. So let's rewind it just a little bit. Okay. Okay. Look, see now just watch. So this is at 16, 17, 19, 20, and this is subtracting. Now, market orders, contracts are being canceled in there, so you may see wild swings in the ask or the bid. So, and this volume's going up. This is historical data. Yes, it is. It's almost like a chart, and I'm based off of this. I can draw a chart in my head. So now 389, 382, 392. Okay, so this is at 87. This is going to go to 89. I want you to focus on this. Watch this 224 go up to what, 226? Let's see if that's what it goes to. Yep, 226. This went up to 89, and this would drop a little bit. Now, the thing is, there's a lot more to take into this, and because just because you're seeing these numbers doesn't mean what you think. You can really read these numbers and you can understand what's going on. You can get an idea of how the market behaves. Each market behaves differently. They're different personalities, you know. They're like owning different pets, you know. You may have 3 dogs, but they could all be different personalities. Shit like that. And based on how these numbers act, and you get a feel for the market. Now, I want to sidetrack a little bit. You see this market next to it. This is the 10-year. This is a very thick market. And the way when people say thin and thick markets, you can see here there's 2,500 contracts on the bid and 4,900 contracts on the ask. That's very thick market. A lot of contracts trade at any given time in this market, whereas the ES is thinner. Way less contracts trade on average per price. So when you look at the DOM, most markets will have an average amount of contracts trade at any given price on the bid or the offer. So we're going to focus on the blue and red columns only. Remember, these are bids. 2578 contracts have to be filled here before it ticks down to where all these bids are sitting. And currently 1715 contracts came in and bought up. That's how many contracts have been bought up from this bid. So this was originally, what, 4,000? It just really depends. Because, again, people are canceling orders. And when people cancel orders, it can get a little tricky. Just because you're seeing an order there doesn't mean it's fake. People put out fake orders all the time to trick the market and to trick high-frequency trading. So, I mean, we're really diving in depth on reading a DOM, and we could talk about this forever, but we want to go over the basics for you to understand. So now that you kind of have an idea of how it all works, okay, we're going to analyze a trade and how you can just trade off a DOM without using a charts. Okay, this is going to be a breakout trade to the up on the E-mini ES. Okay, and currently this is 2 minutes before the stock market opens up, all right? So usually when the stock market opens up at, I think it's 9:30 New York time, that's when the most volume just starts coming in at exactly the opening bell. So since I'm Central Time, it would be 8:30 a.m. when the market opens. So you may not be able to see it, but I have a clock down here in the bottom right. It says 8:28 a.m. So the market's about to open, and during my live session, I unfortunately didn't take the trade, but I totally called it out, and I was very confident it was a good trade. So therefore, this is a fantastic example. So it's almost 8:30. The market's sitting at a high, so I'm kind of playing detective here. And this is how I sort of predict shit without using technical analysis or anything else other than the DOM, the order flow. This is also called order flow, or, you know, the order book. Should have said that in the beginning, but whatever. Anyways, we're 2 minutes from the opening. We're at a high, okay? And one thing I notice on the DOM is certain things will stick out, okay? Certain things don't look right. For instance, this 588 is an unusually large order compared to all the other orders, okay? Other than this 522. This is also a large order because we are at the high. And again, when you're at a high, there's going to be resistance, right? And the way you can tell there's resistance is there's more asks versus there's more asks versus bids over here. More offers than bids. More supply than demand. Okay, think of it like that. More supply than demand. More people want to sell at this price than more people want to buy at this price. 388 is lower than 522. So that's telling me the market is in favor of sellers because the offer is larger. So therefore, that's telling me this is going to be a resistance zone. So if you go up a few ticks, 1, 2, 3, 4, so that's a point. Remember, 4 ticks is a point. If you go up a point, there's 588, and it'll briefly go into the 600s, and then it cancels off. And kind of watch that price when I play the video. Usually when you see a large number on the ES, an unusually large order sitting away from the current market off of a high, usually the market will trade up to that point. It acts like a magnet. And that's something I only really see in the ES. And I only trade a set markets, and that's it. I don't bounce between different markets. So I know for sure in the ES, this 588 contracts at 29.18 even, that's the price. That's going to act like a magnet. That's almost like the next zone of resistance. And it's going to be. You'll see. So first we have to get through this resistance zone. And we're going to play the video, and I'm going to be calling stuff out. So here we go. So it's 2 minutes from opening. Nothing really, is standing out. Now it's up to 606, right? It's unusually large. People are canceling orders. You can see it goes down to 591, then it flashes to 606. Now it's down to 589 up there. Okay, the market's trading here. 77 contracts have hit that, 221. Okay, now I'm going to pause it. Something here is telling me that the market is going to break through. Okay. The bids have pumped up to 438, and the offer has dropped down to 484. Remember, it was in the 500s on the offer, and down here it was in the 300s. So now the offers are pulling off, and the bids are pumping up. Okay. So that's telling me that the tables are turning. And also, 221 market orders have came in at this price, at the 29.17, whereas only 77 sell orders came into 29.1675. So more market orders on the buy side have came in, And in fact, if you look at all the numbers, 46, and remember it's staggered. You have 46 versus 202, 25 versus 171, 60 versus 237. These numbers are all larger in the blue, meaning there's more buying pressure, and buyers are more interested than the sellers are. As you can see, the numbers are a lot lower. However, the sellers stepped up right here, and you can see 211 came in right here. So naturally, the sellers are trying to defend this edge right here. They're trying to defend the high, and this is what you can see in a DOM that you can't see on a chart. And as you can see, an unusually large amount of buy orders came in right here at this price, 877. I mean, if you look down here, the market moved up on lower contracts, and that's telling me the sellers were fighting back right here and the buyers were fighting really hard to get through. Now the buyers have got through this level. Now they're trading up here, and we have yet another 221 contracts versus 77. So if this bid pumps up and this ask starts to drop away and I'm seeing more market orders come in, that's telling me this is going to break through the high. So let's play it. Okay, now it's kind of reversed. This is pumped back up to 516, and this is dropped down to 361. This is telling me the market's still looking a little weak. It's not looking like it's going to break through anymore at this point. However, we want to watch it. You're having market orders hit in right here. You're having market orders hit in. Okay? Sellers are attacking the bid. Sellers are attacking the bid. Buyers are attacking the offer. Buyers are attacking the offer. Sellers are attacking the bid. Sellers are not attacking the bid. There they go, attacking the bid. Buyers attacking the bid. Offer. Buyers attacking the offer. Buyers attacking the offer. Buyers attacking the offer. Buyers attacking the offer. Watching here in the green. Okay, let's pause it. Notice this. This is pumped up to 620. This is at 597. They're building a wall right here. They're telling at this price we're going to experience resistance. Okay? Because these are pumping up right here. All right? And this offer here where the market is currently trading is at 383. It is now weaker than the bids at 401. You have 375 market orders that hit the order here. 154 versus 375. This number is larger. This number is larger. The bid is larger and the market orders are larger for the buyers. So Team Blue is winning on market orders and on bids versus Team Red. So therefore, this is telling me this is going to break through. And this is going to be an example of when to use a market order, okay? You want to use a market order right when the market is about to tick up. And I'll tell you why in a minute. So you're seeing a crap load of buyers just hitting it. Now it's at 284. This thing is about to break to the next level. It's about to break the high. So this is where you would want to consider doing a market order and get in at this price. Buyers attacking, buyers attacking, sellers attacking, buyers attacking, buyers attacking. Boom, there it goes. Okay, what time are we at here at 1:32:09? I'm going to rewind that a little bit. Okay. 1:32. Oh, this is there we go. All right, I'm going to play it, and you're going to watch it happen. This is, you want a market order. When you see this thing getting flooded with numbers, that's when you want a market order in. See how it's just cranking up? You would have wanted to get in somewhere around there. And again, here we are. We're starting to hit that resistance zone I told you about. Notice that? Look how the sellers are really attacking here. Notice how there's 817. Okay? 817. All right? The sellers are now trying to dig in. Or people could be liquidating from that trade. Okay? that could also be what's happening. People who got long where I would have got long are now selling right here because they saw that this large number, the 748, this is the next resistance zone. So therefore, that would have been a nice scalp, a quick trade. That's something I personally look for. And now in stock market, it's, you know, you maybe want to do more long-term swing trading, but this allows you to really precisely fine-tune that entry, and you can use technical indicators to help you figure out where that's going to be. So either people are unloading and that's what's happening, or sellers are trying to fight back, or it could be a combination of both. Now look at it right here, over 1,000 on both ends. Buyers and sellers are really attacking each other. So now you need to be kind of looking at the bids here and the offers here. And I can see the 600 here. So this is where we want to look at the turning point, and this is, it drops in from this point. See, it really struggles when it gets here. This is the wall. This is it. And now you can see the profile step. See how 207 contracts briefly attacked the 2918? And look, only 207 on the volume have been built. Right below it, a total of 1747 have traded at this price. And it doesn't matter if it's a buy order or a sell order. So I think this video has gone on for far too long. And you can see this very large 620 order. That tells me the resistance is solid. And when the buy orders attacked it, it did not go away. If the buy orders attack that, and that would drop to 300 and it wouldn't pump back up to 600, that's telling me the sellers are giving up and this thing will keep going. However, when the buyers continue to attack this 600 and it holds firm around 600 contracts, it keeps refreshing because there's hidden orders or iceberg orders or whatever's going on. That's telling me that's a strong resistance zone. And it's looking weaker down here. You know, you only have 447 contracts, the price below where we're currently trading versus here. So, I mean, it just looks stronger. And okay, see the buyers were attacking right here. And they just briefly lifted it. However, now it's getting absorbed. This is pumping up. Look, even though all these buy orders are hitting, this is not getting taken because people keep constantly adding orders right here. Even though the market orders are coming in, people are adding orders, and it's like absorbing water like a sponge. These market orders are being absorbed by everybody adding on the ask right here, and it cannot get through. Look how many contracts traded right there. Let's rewind that a little bit. I think that's a really good lesson, and it needs to be re-seen with your eyes. So 3307. So watch how this just cannot be taken out by the market orders. Look how the market orders are just, watch, they'll start cranking in right here in the blue. We just care about the blue right here. Cranking in. It's not taking it. Takes it, but even though it takes it, it briefly trades back down. You saw how it briefly blipped up and then back down. Buyers instantly sold right here to where the buyers couldn't, our sellers instantly sold 343 contracts, instantly bringing the market back down, and buyers weren't fast enough to put a bid in at this price. And look at the absorption here. All these contracts attacking it, and then we're briefly up here. 41 contracts attack. However, it's weaker down here. There's only 64 versus 454, so sellers are going to drop it in quickly. See how they're aggressively attacking it. They're eating up those orders, eating up the orders. Now that the sellers have eaten up the orders, they're going to try to hold right here. You're seeing all these market orders come in, and well, now it's over. That's all over. Oops, didn't mean to do that. And then the market just collapses in. So that's just kind of what the DOM can show you that you can't see on a chart, and that's how you comprehend a DOM, and that's how you can use it to your advantage. And seeing this information is allowing you to see exactly what's going on. You cannot see this information on a chart. And technical indicators don't work all the time. However, technical indicators can help you confirm taking a trade. And when your technical indicators give you your buy or sell signal, you come to the DOM, and what you do is you carefully watch the DOM for that precise entry. Or you can just scalp off the DOM and not use charts. And if you're going to watch multiple DOMs like I do, you just have to sit somewhat further away from your monitor and just sort of really use your peripherals. And you just got to sort of scan everything like a lifeguard scanning a swimming pool to make sure nobody's drowning. That's sort of how you do it all. It's a lot more intricate, and there's a lot more in-depth information with it, but that's a very good primer, and this is probably the best video you're going to find on explaining the DOM on YouTube, period. So, give me a thumbs up for this. And if I can do a better video, I'll probably re-update this video later down the line. So hopefully that helped. And good luck with your trading.